All right, chapter 9. What's the difference between a tangible and an intangible asset? One you can touch and one you can't. All right. One you can what? No, that's all right. What'd you say?
Move.
Well, yeah, you can't move something you can't touch, so that's not a bad answer. All right, so this chapter we're going to spend most of the time on tangible. All right? You're going to need to know what intangible is, but there won't be any problems on intangible. There could be an intangible journal entry, but it's more going to be like a couple multiple choice. Like that's the most. The majority of what you're going to spend time on and your problem is going to be on tangible. So give me an example of a tangible asset. That pen, equipment. You? What'd you say?
He said a building.
Oh, I thought he said you. Okay, I guess technically I could be a tangible asset, but can you put a price on a person's head? No.
Yes.
All right, we'll come back. All right, stay away from us, Shayla. She just said yes. She can put a price on your head. Okay, so, but yeah, anything you can physically touch. So we're going to talk about them, classify them. The problem that I curved out of that test, we really talk about in here. All right, the fact that you are going to include in the price of an asset everything it costs to get it up and running. And that doesn't also include intangible assets, but everything it costs. Because once that product is gone to production and done and you're selling it, that's the price until you have to completely rehabilitate it, okay? And we'll talk about some things when we get to that. So, define and classify. Well, number one, an intangible asset is something you're not going to sell, all right? In inventory is what we're selling. An intangible asset is something we plan on keeping. And then we have our tangible and intangible that we already talked about. So examples we gave, land, buildings, equipment, so property, plant, and equipment, right? Things we can touch. Assets are typically depreciated. We do not depreciate land. Does anybody know why? It usually goes up in value, we hope, and it doesn't go away, right? Does it go away?
Unless it breaks off.
Okay, unless it breaks off. Okay, so if you're in California and you're on that piece that everyone keeps telling you is going to break away and saying, okay, extreme circumstances, but for the most part, land does not go away. Does a building depreciate and become unusable? Yes. Does land become unusable? For the most part, no. The area around it becomes unusable. Natural disasters we're not going to talk about, okay? But the area around it could go down, but the land is still usable. Right? Intangible assets are things such as copyrights, patents, trademarks, goodwill, which we will talk about. And if anybody ever tells me on a definition that goodwill is a store, I'm going to take 2 points out of the grade book for you, okay? Just so you know. All right, and we'll define those. So some intangibles have a limited life. The majority of them do not, meaning we don't know how long they're going to go for. And I think I already asked you guys this question. What do we believe, or what do I at least have the knowledge of, is the longest trademark right now? Coca-Cola. All right? It is at least one of the largest, to my knowledge. Longest, not largest, longest trademarks. All right? It's longer than AB. Okay. It's been around forever. Really? Okay. So what do? We got what's called the cost principle that we apply to tangible asset. That means that we keep it at cost. On our books, it is at the cost that we acquired it at until we sell it. Because how do we know what we're going to get for it when we sell it? Until we sell it. You have no idea. We believe, if you ask anybody what this college is worth, this specific campus, we believe it's worth a lot of money. Why? Location. Do we know how much money? No. If you call it a real estate agent, they'll come in and give you an idea. Do we actually have any idea? No. Because I believe it'd probably get in a bidding war of some sort. All right? Because people would want the location. I can tell you it's worth more than we paid for it back in 1960-something. All right? Just like when we bought the land where Marquette is. We bought it at a cost. We sold it, I don't even know how many years later, at a lot more than we bought it for. Because the location became a lot more desirable. So we're going to look at the purchase price and then everything necessary to make it whatever it is. The cost of the Wildwood building was not only what we bought the land for back whenever we sold the Marquette land, all right? But then once they built on it back in 2005 and 6, all it costs to build the building and all the surrounding, all right? That's what it, now, that's called capitalizing costs. When you include all those other costs, you are capitalizing it. When you make significant changes to something, for example, CN is closed. The building Communication North is closed. For you, those of you guys that were here last year, you know that that's kind of a bummer because if nothing else, you cut through it when it's raining to get to other parts of campus. They had to close it because they kept having roof problems. They kept patching it because of asbestos. If you go and do major changes, you have to gut it. Well, they finally just decided that they were going to gut it and redo it. So that's a major overhaul, so therefore they will be capitalizing those costs and putting it into the costs that they carry these campus buildings at. All right. So here's a few examples. Land. When you purchase the land, not only do you have the cost of the land, you got legal fees, you got survey fees, you got title and search fees. Those are just some of the costs that you have when you go and buy land. It is not just going out, getting a realtor, and saying, I'm buying that land. When you buy a building, you either are purchasing or constructing it. Forest Park, we are building a new building down there for the Health and Allied Services. So they are building a building from scratch, so it's construction, but they are also having to tear down, I heard now they're tearing down 2 buildings. I thought they were just tearing down building A, they're tearing down building B in order to make room for it. So they have construction and demolition. Legal fees, appraisal fees, architecture fees, all those fees go into the cost of that building. And then equipment, again, purchase and construction. Every other year, roughly, Six Flags adds a new ride of some sort. In order to add a ride, sometimes they have to take down a ride. This past year, they added a new water ride, and they had to take down 3 slides. So they had to construct it. They had to tear something down. They have sales tax on it. They have transportation costs of the equipment, and then they have installation costs. So all those have to be put in, but not advertising costs. Yeah.
And when you buy land or a building, is there sales tax?
It could be, depending on what you're buying. There could be sales tax as well, but there's always sales tax on equipment. Land is going to be, yeah. Land could be, but like when we buy a house, there's not sales tax. There's real estate tax. So it's a little bit different. It's going to be probably real estate tax, not sales tax. And you're going to pay that annually, not one time. So they hit you longer. Annually is worse. All right, so then there's something called a basket purchase. We've already done this. All right, so that's kind of a nice thing with Chapter 6. We did it, so now we kind of already know how to do it. So you guys are going to impress me here. Tell me how you're going to figure this out. And I'm going to go find out for sure when the food is done. Tell me how we're going to allocate this building and land. All right, so let's go ahead and take a look. I'm not going to do it on the board because we've done this. Normally I'd have to write it on the board. But, so we add it up, boo. So we add it up, get the original value, 500, and then we take each one as a proportion of that 500. So 175 of 500 is 35%. 325,000 of 500 is 65%. So we see what the original proportion was, and then we multiply that times the 400. So the new price of the land is 140, and the new price of the building is 260. So we allocate that out. And then we could do the journal entry, which would say land 140, building 260, cash 400,000. All right, so we got a good deal. But we cannot sit there and put it on the books as 500,000 because we didn't pay 500,000. We got a good deal of 400,000. Does that make sense?
Yeah, it probably just makes it look like the land appreciated.
Well, no, because if you look at this, we don't know that the land was more. All right, this is what it looks like the land was when we got it. But once we put it on the books, the land was never over that other value. All right, this is when we got it, we're saying, here's the values, but now on our books it's 140. So the good part is when we go to sell this, we're going to be able to recognize a what? A gain. Okay? All right. The other thing real quickly is just to kind of talk about some of the differences in IFRS. All right? So for those of you going into accounting, you can kind of see what you got ahead of you. We depreciate in this chapter based on the plane. All right? The plane you put in service, and we depreciate it over a number of years. But we depreciate this whole thing. So when the plane is done, it's done. Cars are depreciated usually over 5 or 7 years. All right? So when we depreciate it down to its zero value, or the salvage value, then it's at its value. IFRS says, you know what? When you look at this plane, does everything in the plane actually depreciate at the same rate? No. Think about the wear and tear on the inside of a plane. Does that depreciate, and do you wear that out quicker? Yeah, all right? They tried to come up with better things, and you guys are young, but the seats didn't always used to be leather. They used to be cloth, all cloth. So did that wear out faster than like at least now, even some of them have some cloth, the headrests are almost all leather, right? You can clean them better, they last longer. They found that they might be a little bit more expensive, but they last a lot longer. So they're going to depreciate the inside of the plane over 5 years, and some parts of the engine over here over 18, these parts over 25. That's how IFRS does it. It does it based on components. Do you think that takes a little bit more effort? Yes. All right, so let's look at an example. So we got Cedar Fair, which is an amusement park. All right, they got a new ride that they purchased for $26 million, and they got a discount of $1 million when they purchased it. They paid $125,000 in transportation, $625 in installation. What would the journal entry look like, assuming that they did a notes payable for the roller coaster and paid cash for the transportation and the installation? What do you think? It's a lot of words. First thing would be equipment. And what would equipment be for? What is the value of my equipment? 26?
But they got a discount.
But they got a discount.
So 25.
So 25. Okay? So 25 million?
Mm-hmm.
Everybody agreed?
And then we add 125.
And then we add 125
And 620.
and 625. So 25,750,000 or 25 million
For the equipment.
for the equipment. So we're still talking about equipment. So is equipment a debit for 25 million or is equipment a debit for 25,750,000? Those are my two options right now. We got 2 for 750,000. 3, now we're all going up. All right. And that's because what did we just say? You include everything. So we added up. Everything is included. The only thing we do a little bit different is they said we paid cash for the installation and the transportation. So that's the only thing that's different. Every once in a while I get somebody that says, but wait a minute, it's a discount. Okay, it wasn't a discount if you did something. It was just a flat discount, so it comes off the top. The only time you list a discount separately is if it's a discount because you did something, right? Like our 210 net 30. This was just, whoop, a discount off the top. All right, so what do we do about maintenance costs? All right, so ordinary repairs and maintenance are ordinary repairs and maintenance. They are still just expenses. They're relatively small. They occur on a normal basis. They don't increase productivity. They don't extend the useful life. So, for example, what happens when the armrest breaks on an airplane? You fix it, right? Yep. Is that a big cost you add to the airplane? No. What happens when the seat in front of you doesn't sit up? That happened. Like it's stuck in recline. You fix it, okay? If they have to replace the whole seat, do they just replace the whole seat? Yes. That is a relatively small thing. All right? Are there maintenance on planes all the time? Yes. All right. That's what delays planes, right? Way too much, unfortunately. Well, you get new tires on a car. Is that maintenance? Yeah. Oil changes? Yeah. New engine? No. All right. Now on a plane, I don't know, I can't get into that much detail on a plane, but on a car, a new engine, is that going to extend productivity? Okay. So let's go to our amusement park. If I am replacing pieces of a track because they're worn out, is that maintenance? Probably is maintenance. If I am putting a brand new roller coaster cart into play, that's not probably maintenance. Because is that going to extend the life of that roller coaster by adding a brand new car? I probably took another one out of play, right? Or they did something to the boss several years ago. and they took it down for a month. They extended the life, I don't remember what they did, so we're just going to say yes, okay? They extended the life of the boss by doing something to it. All right? So you're looking at relatively large, infrequent, major overhauls. They could extend the life, or it could just increase productivity.
This really depends on just.
It depends on what it is
Industry to
and the
industry.
industry they're in, right? Some things extend the life. I don't know what the life of the boss is. All right, it's one of the world's largest wooden roller coasters. So are they extending productivity or life? More than likely life, because it doesn't produce anything. No, they're probably just keeping it going. All right. So the cost goes on the balance sheet. The expense goes on the income statement. That hasn't changed. So when we're looking at depreciation, nothing has changed with how you guys are looking at it. Okay? Nothing has changed so far. Accumulated depreciation goes on the balance sheet. Depreciation expense goes on the income statement. Journal entry for depreciation, nothing has changed. So what is going to change? Well, we're going to talk about a few things with it changing. We got to talk about what's called useful life and residual value. I think hang on, looking at what I want to do. 9-2. I can't read my sloppy handwriting, so I'm looking. Yeah, let's go ahead and work a problem real quick. Let's go back and get just a couple more slides in here. So in order to calculate depreciation, when I tell you about the 3 different methods that we're going to use, you have to have 3 things. You have to have what it cost. All right. You have to have what's called the useful life. So the useful life is, and we'll start abbreviating it just life, but useful life is how long you expect that asset to last. In most of our examples, it's going to be 3, 4, 5 years, just because we're not going to go farther than that. But a useful life could be 7, and when we do it for tax purposes, there's set useful lives, all right? But a useful life is how long you expect it. So for buildings, it very easily could be 27.5 years or 35 years, okay? And then you have something called the residual value, which I'll abbreviate RV, and I will also sometimes call salvage value because they are called both. All right, the book I had growing up was salvage value. The book I used prior to this book was called salvage value. What residual value or salvage value means is what do you think your asset is going to be worth at the end of its life. For example, prior to me getting a new car, actually prior to my son wrecking the car that he got rid of, even though that car was 8 years old, even though my son now is driving a 2003 minivan, it's not worth anything, but yet it is worth something. If you pull it up in Kelley Blue Book, a 2003 minivan with 245,000 miles that isn't worth anything on a trade-in is still worth $1,000. Okay? Because it's worth something to somebody. So that is this residual value. Did we depreciate that car? Yeah. If you asked Kelley Blue Book when we bought it, it would have said it was good for 5 years, maybe 6. All right? Every year it goes down. But a car eventually gets to a point where it's worth something. That van's life hasn't changed much in the last, I don't know, how old is it now? 17 year, 8, whatever it is, old, 14 years old. So it's going to stay at that 1,000. That's why my dad didn't get rid of it. It was worth more to him as a third car to haul stuff than it was to trade it in for $1,000. And it's definitely been worth more to us to have as a car for a high school driver than it was for him to trade it in, as long as it keeps. I mean, obviously it can get hit by a car or, when something happens to it, but as long as it's running, it has a value of, roughly. Now, if I go to Kelley Blue Book, and what is the dealer going to give me? Remember, you don't know what something is worth until you sell it. What is that 2003 Dodge minivan worth? Well, it depends on, it's actually Town and Chrysler minivan, but whatever someone is willing to pay for it. And at the time my dad looked at trading it in, they were going to give him $1,000. I don't know what someone would give me right now. Everything has a set residual value that a company is going to place on it. Okay.
There will be no more depreciation.
Well, that no more depreciate. Once you're done depreciating it, that's the residual value. Some will have a 0. meaning they don't think it's worth anything. And then it's trash. All right, so depreciation goes on your income statement. We know that. Accumulated depreciation on the balance sheet. Cost minus depreciation gives you something called book value. You're going to want to remember that. Book value is what the asset is worth. So cost minus accumulated depreciation gives you book value. It is also called carrying value. We are going to learn 3 different depreciations. Straight line, units of production, and double declining. I'm going to give you the formulas, and then we will stop. But these are the formulas, if you didn't know them already from the videos. Cost minus residual value divided by life is straight line. Does anybody know why we use straight line? What's the advantage of straight line? Who did the videos?
Same expenses.
It's the same depreciation expense every year. So once you figure it out, you're done. All right. Units of production, there are 2 formulas, the book and mine. All right? So cost minus residual value times the number of units in a year divided by total units. And units are going to be whatever that item is. So if it's a roller coaster, it might be miles. If it's a production line, it might be units produced. Cost minus residual value times units in a year over total units. The other formula that you can use is cost minus residual value over total units, which gives you something called your depreciable rate. And then all you do is multiply that by units, I can't spell, units in a year. I still can't spell. I think this one's faster because once you get the depreciable rate, all you do is multiply by the number of units each year instead of going back through this formula over and over again. They both get the same number. All right? So we'll walk through those on Thursday. And then double declining is cost minus accumulated depreciation times 2 over the life. So if you don't remember, you were supposed to do the videos for class today.
No, you didn't do videos for
It was 8.
Oh, I take that back. So for Thursday, you need to look at the videos, and I want you to try to do that problem right there. It's a very simple problem. You have a cost of $62,500. You have a useful life of 3, right? Yep. A residual value of $2,500. I want you to try to do it for each one.